Welcome back to the Williams Real Estate channel. Today we are discussing the macro market update for October 2025. We use the 18-year land cycle framework to invest in property, and the purpose of this video is to hone in on this framework to give you data points so then you can have clarity and understand where we sit, being on that blue marker, 12 months away from peak market, 2 years away from the next end of cycle land driven downturn, the likes of the 2008 GFC or the 91 recession we had to have, or the early 70s. We're due. Come 2028, we're due for the end of cycle recession. And the purpose of this video each month is to provide you clarity and show you data points that I look at to indicate that, yes, we are on track. Yes, we are on this blue marker and the downturn is coming. From that, we peel back the layers and go to a micro level, all the way down to suburb, even types of property when we come to buying investment properties. As there's not one property market, you'll find, if you do the research yourself, that historically Sydney and Melbourne outperform in the first quarter, like what happened post GFC from around 2008 to 17. Sydney, Melbourne boomed. People then decentralize as they get priced out and head out into their respective regions. That's when we see the likes of regional Victoria, ACT, Tassie outperform in the second quarter, just like what happened from around 2014, 2015 to 2022. Come mid-cycle, we go through the mid-cycle slowdown. This time around, it was called the COVID recession. Historically, stock markets take a 30 to 40% correction, property 5 to 10% in the likes of Sydney, Melbourne, VIC, New South Wales, ACT, and Tassie. People then decentralize out of these regions and then head out into the likes of Brisbane, Perth, Adelaide. That's when they outperform in the third quarter, just like what has happened from 2020 to date, as well as 2000 to 2007. So it's not just a coincidence that it's the COVID bubble out of the mid-cycle slowdown, forcing demand into those regions. It's historical trends. And we are now on the blue marker in the fourth and final quarter when the likes of Darwin, regional South Australia, regional WA, and regional Queensland outperform in the fourth and final quarter. So we use it as a guide to work out, okay, which markets are due to boom, which markets are due to top out, which markets are due to stagnate. So then we can buy into the markets after stagnant flat periods, before their booms, to get immediate growth within the 5-year window. Everything I bought ever has always doubled in value within 5 years. It's using this framework. So the framework is key. Purpose of this video is to talk about at a macro level of how I believe we are on this blue marker so you can be prepared. So kick it off first, Australian GDP growth numbers. There hasn't been any further data as of June 25, but has been pretty well sluggish in recent years. Historically, towards the end of the cycle, when land price is so high, it can restrict growth. So that has been reflected in the data. We'll continue to monitor this, but if it dips into negative, like what happened during 2020, 2 quarters of negative GDP is a technical recession. So it's borderline. The economy's bumbling along. Come 27, 28, we could probably see the GDP numbers really dipping down and even going negative. The Australian unemployment rate is continually trending up. It is up to 4.3% as of September. And we saw data out of September, unemployment rate up to 4.3. Unemployed people increased by 4,000 to 661,500. So 4,000 people lost their jobs in the month of September. Youth unemployment rate is up to 10.2%. So it is low in historical averages, but it's trending up. Once it trends up, historically, if you look back at 50, 100 years of unemployment, It always trends down until it hits a trough, and then once it starts to trend up, it never goes down again. It continues to trend up until it will run very high, like what happened in 2020 and 2008 and in the 90s. So it's trending up. Come 2027, 8, it'll probably start to run up to 10, 12, 15%. Who knows? This time round, we're due for a big one. Every second end of cycle land-driven downturn is a big one. And I think this one is going to be catastrophic, as I'll explain in future slides. Australian inflation also ticked up, the trim mean up to 3%. It has been trending up since it troughed out in June. So it was trending down to June to 1.9%. But as of recent months where they've been dropping rates, that is kicking off another wave of inflation. As you can see, July 2.8, August 3, September 3.5. So the trim mean is at 3, but as you can see, it's trending up. So get ready for another wave of high inflation. And for that reason, I don't see rates coming down. The RBA met yesterday and held the cash rate on hold at 3.6%. Their key remarks out of their statement included inflation picked up to 3%, as you saw in that previous slide, materially higher than what they were expecting. They believe this is due to energy rebates coming to a close. So the government is now no longer taking your tax dollars to refund the higher cost of energy. So that's going to push up inflation. That's been reflected in the data. The pickup in private demand remains ongoing and strong. The housing markets continue to strengthen as house prices continue to rise, along with rising construction costs. Unemployment rose to 5.5%, which is the next slide, higher than expected. In September, they noted that there's lots of job ads out, and based off feedback, surveys, feedback, the private sector is still finding it hard to attract good labour, as 2/3 of the growing jobs in the last 5, 6 years has been in the government sector. There's a big government at the moment. There's lots of jobs. So it's making it hard for the private sector to attract the labour as the government keeps creating jobs, propping it up. The current monetary policy remains lightly restrictive in the RBA's eyes. Today's decision on monetary policy was unanimous. Time will tell. The next decision is on the 9th of December, but we probably won't see as much data come out between now and then, and I don't anticipate any movement either up or down in the cash rate until probably February, which I wouldn't be surprised if they go up. Personally, this is always by no means financial advice. I'm not a financial advisor. This is my story, this is my thoughts, and this is what I'm doing. I'm refinancing my whole portfolio currently, and I am fixing for 2 years at 5.2%, the whole debt of the whole portfolio. I see rates going up from here, and ultimately that's what the 18-year land cycle suggests, is in order to end the cycle, inflation will kick off again, like what we saw in the 70s and the late 80s. We'll have another wave. They'll then be chasing their tail again, raising rates towards the end of the cycle, which will ultimately set off the final boom, and then will be the final setup for the bust come 28. So I am fixing my rates at 5.2%. Thank the Lord that they held. I'm in the process now that the banks are going through, so I'll have that locked in probably the next month, and I'm backing rates to go up from here. So I wouldn't be surprised if they get up to 7, 8% again to ultimately end the cycle. The US GDP growth rate hasn't been any further data as of Q2 25, but we keep a close watch on this as the US leads the global economy and the 18-year land cycle. So time will tell, but at this stage, the current Q2 2025 GDP growth rate is sitting at 3.3%. The US unemployment rate rose in August to 4.3%. So again, similar to Australia, it troughed out in 22-23 at the mid threes or low to mid 3% point and has been slowly trending up ever since. So it will continue to trend up, I believe, until at some point something will break and then it will run once businesses start laying off people like crazy again. The US inflation rate has picked up to 3% in September. So unemployment's up, inflation is up. Brings us to the US Federal Reserve dropped rates. Can you believe it? The unemployment's up and inflation's up and they're dropping rates. I don't know if they know what they're doing. Maybe Jerome Powell is hopefully trying to keep his job, so he's dropping rates to keep Trump happy. Who knows? But I can't fathom or work out why they'll be dropping rates if inflation and unemployment's going up. So time will tell, see what happens, but more than likely inflation's going to keep running hot, especially with rates coming down. So this is the setup. You can see now that I guess if rates come down a little bit, that's going to set off another wave of inflation and they'll be chasing their tail with egg on their face, trying to rein in inflation again in 26 and 27. Peace deal. Trump has made a peace deal in the Middle East for now, hopefully. Hopefully they don't start bombing each other again. But at this stage has created more confidence in the market. He only needs to wind up Putin and Ukraine. And if he cleans up all the wars, then I see 26, 27 being the ultimate years of euphoria, where he declares victory, that he's the greatest president in the world, ending all the wars, creating the biggest and best economy in the world. That will mark pretty well close to the peak land market come 26, 27, and you can see it. He's cleaning them all up. He's got one more to do, and this will then bring a lot of euphoria, a lot of speculation into the markets as people will believe we're on to the next growth wave, stability with all the wars coming to an end. This is going to be the setup in 26, 27. So further to that, Albo finally got his meeting with Trump and was probably brought forward because China banned all critical minerals and the US was eager to cut a deal. 13 billion critical minerals deal between the US and Australia is just a start, I guess, for rare earths and mining. Typically in the final stages of the cycle, there's a high demand for critical minerals, iron ore, coal, that all goes into building and construction globally. So they'll set off our mines. They'll ultimately boom the likes of Brisbane, regional Queensland, Perth, regional WA, and Darwin, just like what happened from around 2006 to 12, 13. They'll go through a big boom. But when the market turned, come the GFC and the demand slowed down for the raw earth material, the jobs dry up, the mines slow down, people lose jobs, they then flock back to Sydney, Melbourne are wait again at the races come 2028, 930 will probably happen again, just like what happened in 2008 and onwards. So even though these deals are getting made and will stimulate the likes of Western Australia, that's getting over 8 billion of investment over the next couple of years, probably not worth putting your money over there at this stage because the growth has already been had and you'll probably be buying peak market, just like what happened around 2007, 8. Come 2009, the markets switched off and started going the other way. So don't get caught up on all the fuss. This is positive though. Building a good relationship, ongoing strong relationship with the US is key for our stability and security. So it's good to see Australia buying nearly 7 billion of US defense equipment. Australia's superannuation funds will increase their investment into the US by 1.4 trillion by 2035. So that's where all your super is going, is into the US markets. So if you don't want that to happen, you can set up a self-managed super fund and you can control your capital and buy property in Australia if you wish to do so, as having your capital managed by the government at this late stage of the cycle and sending it over to the US and putting it into the likes of the Dow Jones, S&P 500 when they're already overpriced, maybe not the most wisest decision, as we're due for the end of cycle, at which point historically stock markets globally have taken a 40 to 60% correction. So if you don't want to see your super go down by 50%, probably a good idea to think about how you allocate those funds in the future years ahead. Australia will buy US beef, supposedly, even though we've got more beef than we can consume. NASA and Australian Space Agency agreed to work on space technology development, and Australia and US will invest in AI and other critical technologies. So all good things. The main point is the critical minerals deal. However, only a week after Albo and Trump sat down to cut a deal, Trump was off to meet Xi Jinping to cut a trade deal with China. The main point was China agreed to revoke critical minerals ban. So this was the main reason bringing Australia and the US together, I believe. Trump needed us to for urgent critical minerals supply. However, it looks like China's taken off the ban, so it's probably not as urgent as it was initially expected. China will also take significant measures to end flow of fentanyl into the US. So they'll ultimately stop people from getting ill and strengthen job markets, strengthen the economy in the US, and China's retaliation against the US. So this is in relation to tariff wars and China to open up their market to the US for soybeans and other agricultural exports. So it's good to see the US and China getting on. Ultimately, that will create stability in the markets and confidence in the markets. And I think we're here. I think we're due for the final 2 years of euphoria before the old bust up come 2028. So as you can see, it's all getting priced in to the stock markets. Stock markets are rallying all-time high, even though they are overpriced. They're still rallying. This is all turning into euphoria speculation, typical behavior we see at the final stages of the land boom and the winter's curse. But in the background, we see the likes of D.R. Horton, a land and property developer in the US, the biggest land and property developer, home builder, they call them over there, basically build spec homes, is losing steam. So D.R. Horton lost 66% over 27 months from July 2005 to October 2007 before the stock market topped out. So it's a leading indicator. They're pricing in less earnings as the land price is starting to soften in certain regions. And today, D.R. Horton has lost 24% over 13 months from its peak in September 24. So we're tracking this. As you can see, it started to lose a good 50, 60%. Meanwhile, the rest of the stock markets continue to boom. And once it lost about 60%, the overall stock markets topped out and then went through the GFC, where the stock market's lost 50 odd percent. So it's a key leading indicator we are tracking. And once we come close to 50, 60%, it could be any time where the markets are due to switch off and go the other way. Tomago on the blink of collapse. This time round, I said before, I think it's going to be massive because every second one historically is a big one. As an example, 2008, Australia sailed through. We weren't as affected. Obviously, our stock markets took a hiding, but property was pretty resilient. If you go back to 1990s, that recession was massive, and that was ingrained in the baby boomers' psychology ever since. Every second one is a big one. So this big one is going to be like the 1990s recession we had to have. Paul Keating, and we've got Jim Chalmers. He'll probably be quoting Paul Keating. This is the recession we had to have come 2028. This time round, there is this obsession with net zero. So the government's looking to not extend the leases or entitlement to operate coal-fired power plants. They're looking to shut them down. The coal-fired power provides about 60% of the energy to the grid, and they're looking to switch them all off and move to renewable energy, wind, solar farms, and hydro backed by gas. It's not enough to support the demand for our booming population, which is booming 600,000 per year, historically 150,000. So this time round, when they want to try and reduce the energy supply, the energy costs are already going up. That's going to fuel inflation. Inflation's going to go through the roof. Unemployment's going to go through the roof because companies like Rio will be shutting down their smelters because it just doesn't stack up. Tomago's current power source from Bay Water Coal Station is due to close in 2028, at which point the energy costs are forecasted to double if they switch to renewable energy sources. Rio Tinto confirms long-term deal is required to lock in cheap power in order to make this smelter run past 2028. Today, the New South Wales government and the federal government have offered assistance, taxpayers' dollars, prop them up, which Rio has rejected as its short-term financial assistance. They need long-term. They can't sustainably operate with 6, 12 months, 24 months of stimulus, or probably, I suspect, stimulus to the end of their term. Knowing governments, it's all political. So thousands of jobs are on the line. So you can see this is one example. There's going to be multiple examples of this as energy price continue to rise. If the businesses can't pass on those costs, they can't make a profit, they end up shutting the doors, people lose their jobs, that's how unemployment will go up. So come 28, when we're due for the land-driven downturn, the government's pushing towards net zero, they're shutting off coal-fired power plants, energy price is going to go through the roof, inflation is going to be up, unemployment's going to be up, it's going to be catastrophic. There's going to be a massive rush towards Sydney and Melbourne because they're the two markets that haven't performed historically in affordable stock. The affordable stock will rise in a time of crisis. Everyone needs a roof above their head. We are in this supposed housing crisis. It's a demand issue. Everyone needs housing. So if you are wise with your investments and you are investing in the right markets today, you will prosper and do very well and hedge against high inflation, because once the market does turn, just like what we saw in 2020, they'll drop rates to near zero, they'll print a shitload of money, they'll all get soaked up in higher asset values and we'll be on again through the next wave. So if you want help, shoot us an email. We can jump on a call, discuss where you're at, see if you align with our strategy, and if we could work together to build you a 10 plus property portfolio. As always, this content is general in nature and is by no means financial or general advice. This is just my thoughts of where I see the markets heading based off the 18-year land cycle and the data as we receive it. Hope you enjoyed that. As always, Thanks for watching. Catch you on the next one.